everyone. I'm just going to close this. All right, everyone. We're going to start. All good? So thank you very much, everyone, for being here today for this session on financial service. My name is Wade Rocknedin, and I work for UNDP. I'm very happy to have you all today. This year, we launched with our partner EPFL, Orange, and SAP the Growth Stage Impact Venture. So it's a very rigorous selection process to selection only growth and mature entrepreneurs working on solutions for the SDG in developing countries. So we received more than 120 nominations for the selection process, coming from third parties such as Impact Investment Fund, such as Responsability, who's here today, large NGOs, family office, UN organization, etc. And the entrepreneurs you're about to see today are la crème de la crème. It's the 12 finalists of this selection process. To moderate the session, I'm pleased to welcome on stage the two moderators of the session, Craig Churchill and Sarah Djari. So Sarah Djari is Investment Director as Responsability. It's her second year for doing this, and thank you for coming back. And Craig Churchill is Chief Social Finance Program at ILO. Thank you very much for being here, and I will let the entrepreneurs take the interview.
So thank you. Good morning, everyone. Welcome to this pitch session. We've got four really exciting projects to introduce to you, and I'm going to introduce two of them to you, and Sarah's going to introduce the other two. So let me start with Andi Taufan, who's the founder of Amartha in Indonesia. Now, for those of you who are familiar with microfinance, it involves sort of getting often groups of people together to be able to lend to them. And it has fairly high labor costs in terms of the staff and the business model. And so it's possible to make returns, but technology is sort of upending microfinance. And I think this first program that we want to introduce you to, Amartha, is really upending the whole approach and redeveloping itself, repackaging itself, leveraging technology to reach many, many more people, starting in Indonesia, but with regional aspirations. So with that, let me get Andi up to the floor to tell you about his program.
Oops. All right, sorry everyone, I'm just going to check with the sound. Okay, no, it doesn't work, sorry. Is the sound?
Okay. I can skip.
All right, just skip directly. Go directly to presentation, which is right here.
Good morning, everyone. I really care about how we can make prosperity prevails for people at the bottom of the pyramid. Today, I would like to present my business, Amartha, the way we see microfinance beyond just brick and mortar model, how we rebuild microfinance as a woman banking reimagine. This is me back in 2010, slimmer than today. And we started this business like a microfinance Grameen model. So brick and mortar, we serving one village to another with me as the first loan officers back then. And why we wanted to do this? Just to try to solve a simple problem, how people in the village can get affordable loan. And building on that, actually those simple questions truly really show a bigger issue in Indonesia. Indonesia is the fourth largest unbanked, 250 million people, and more than half of them are women. We're here in Amartha, try to make these people at the bottom of the pyramid more prosper. And we started as a microfinance model, and we plan, now we are a peer-to-peer lending platforms. We're connecting those borrowers, unbanked in rural areas, women micro-entrepreneurs with lenders in the urban city. So we are building a new asset class for lenders so they can invest their money directly to the real sectors, to the real entrepreneurs on the ground. And what we learn from there, we can do more beyond just connecting them with lending. We learn how we can make these people more prosperous. There are 4 frameworks that we see. First is we give them loan. Everyone knows it's proven, right? Micro loans really helping people to increase their income. And then from there, we see that we can do more.
Nós acreditamos muito, entendeu? Que nós vamos conseguir reduzir a utilização do químico, entendeu? E a utilização do biológico, e todo mundo vai ganhar com isso. Né? Nós, produtores, a sociedade irá ganhar com isso, com utilização de menos agrotóxicos e reduzindo os custos significativamente.
No, I think that's from here.
That's what we call the soluble experience. So it's basically 4 things. You have a laboratory on farm, then you have the biofactory, you throw the raw materials inside. So we have the raw materials based on bacteria and fungus, and then we have the whole support. We train people on farm, we offer them support, consultants, what they need to use, when they need to use, and so on. That's our, so it's an experience. You cannot buy only the biofactory. You are only allowed to buy the whole thing.
Okay, yes, let me continue. So the way I learned about this 9 years experience providing access to loan for women in rural areas is loan help them to increase their income. So first, how we can make people more prosper, we give them loan so they can increase their income. And then next, how we can help to reduce or decrease their expense. Mostly for people living geographically remote in villages, their cost of living much higher because the distribution of the products are more expensive for logistics and everything. So, and also their minimum cash flow makes them have to buy product in sachets instead of they can buy bulk. And we have the opportunity how we can leverage the community of borrowers in Amartha so they can go together and decrease their expense as a community. And then from there they can build their own savings when they have more spare income, and then move on from there how we can help them explore micro investments, micro insurance to build their assets for the futures. And that's the way we see that we are here in Amartha building new age of microfinance. So where are we right now? So we are starting with women, building strong base relationship. We create self-arranged community of 15 to 20 women, and we give them loan for productive purpose, starting from $300 loan. Once they finish, they can increase the loan to $500, and then they can continue increase up to $1,000 to $1,200. And then they can get loan from lenders. Lenders can get spread return from 12 to 15% per year in Indonesia rupiah. And how we manage risk? Yeah, we do have joint liability model, and we partnership with insurance to protect risk for the lender side. So where are we right now? So Amartha right now we're serving over 300,000 micro entrepreneurs across Indonesia. And next year, we will reach 1 million borrowers and be cash flow positive on our core business model. So, why we believe we can do more than just peer-to-peer lending? We see that what we are doing here in Amartha is built by technology in every aspect of our operations. So we see we can deliver more because our digital backbone help us to innovate or introduce new features, new product with new types of, with a short time period and more in a, more like a startup model where we can continue to iterate our products once we launch. So this mass market segment that we will have next year, we will reach to 1 million borrowers. We see that we can give them more with access to loan, and then we can decrease their, we increase their income, we provide them with loan, and then how we can decrease their expense. We are partnering up with major distributor players, FMCG, and we connect the products directly to these segments because we already have the community of borrowers, and instead of they deliver the product to mom and pop shops, they can deliver the products directly to the community of these borrowers. And we are already in the pilot projects with the apps, the neo-banking platforms, and we're starting to roll out the savings product, goal savings product, so we can build long-term savings, partnering up with banks. So we are in the front end platforms, and we are using banks products at the back end. All the infrastructures and the products design is from the banks, and we are in the front end platforms to make the user experience much more friendlier and simpler for the borrowers. And then we continue to explore more in the insurance product and other types of micro investments for these segments. Where are we right now? So we are grow very healthily in the last 2 years. We are still managing default rate close to 0%, 0.7% right now, and we grow exponentially in the last 2 years. We grow 10x from, if you can see, from 30,000 borrowers to 300,000 borrowers in the last 2 years with lending asset under management 34 million will reach by September. By this end of this month is close to 40 million. And with monthly revenue gross close to 1.5 million per month. And we're very confident this model will continue to, our plan will implement and execute properly in the next coming months, because very well diversified of leaders in Amartha. We combine experts in bankings, in microfinance, in technology, and also in those from diverse backgrounds with aligned missions with Amartha to make prosperity prevails for everyone. So where are we right now? We are already raised over 20 million equity so far from some of the reputable global investors. One of them is, like you can see, one of the biggest banks in Indonesia. One of them is VC Arms from South Korea, internet search giant Line Ventures. And that's it. So I hope this opportunity give us opportunity to share more how we plan in the upcoming months, the way we grow our Amartha, and how we can explore opportunities to many of you who are interested to explore investment in Indonesia, in microfinance, peer-to-peer lending sector, financial technology in Southeast Asia. That's all from me. Thank you very much.
That's why I want to run pilots.
Now we get to sort of probe a little bit more detail. And so let me just kick off the conversation with sort of, if you could just explain this peer-to-peer approach and what was it before, how were you lending before, and how is this peer-to-peer model work effectively? So it wasn't so clear.
Yeah, so in 2010, we acting as a microfinance, brick and mortar microfinance. 2015, we pivot our model into peer-to-peer lending platform. So what is like the model, the peer-to-peer lending is when everybody knows previously like microfinance is more in on-balance sheet lending. We borrow money from banks, from financial institutions, and then we own the book and manage all of the risks. But when we play roles as a peer-to-peer lending, we act as a lending marketplace. So our marketplace model brings our model as a facilitator. So we only bridging all of the transaction. We do credit scoring, we do cash management for the borrowers, but all of the risk, portfolio risk is in the lender side. And what makes this model more interesting is because this asset class, these unbanked segments, women micro entrepreneurs who are fighters on the ground, entrepreneurs in the field, who previously only get access loan from conventional institutions, they can get loan from everyone. So we're building new asset class for the lenders, for investors, and truly make a story of impact investing. So everyone can be impact investors. Everyone can invest starting from $100 directly to the women micro entrepreneurs who starting to expanding their mom and pop shop, who's building grocery stalls or like crackers business. Those kind of business can be invested without worry about the risk of default, because Amartha helped manage the risk.
So it's fascinating that you, instead of taking the risk yourself, you just earn a commission. So it's sort of a risk-free business model.
Yes.
Sarah, you wanted to ask a question first, and then we'll get others in the room. But I don't know how these mics work. Oh, there you are. So just start with Sarah.
Thank you, Andy. In your journey in the past 9 years, you've transformed from a pure brick and mortar model to what I call a touch and tech model to deliver financial services. And you've talked about your project to even become a neobank, where the interface with your borrower would also be digital. Do you see a space for the traditional microfinance, the brick and mortar model? Do you see still a space for this model in an age where pretty much everything seems to become digital?
There are some problems with, when we talk about Indonesian microfinance, the business is not evolving because most of they really truly rely on the founders, and most of the founders of Indonesian microfinance already old, and they're not really talking about expanding the business or bringing new innovative products to serve the segments. That's the way we see from Indonesian market, most of the microfinance existing players. But I would like to share more about why we see that we can do the neobanking platforms model, because when we act as a peer-to-peer lending, we are risk-free, and we are on the only platform side providing credit scoring, and we give them loan and we give return to the lender side. And now we learn from the borrower side. Why can we start expanding their services as a platforms and connecting with banks to providing savings while we are using banking infrastructures, or we're providing this access to cheaper product where we're connecting them with distributors or providing them with insurance as a as a marketplace, so we can connect with multiple type of micro insurance partner, and that's how I see the evolving model of microfinance, so we can deliver more products to them.
Questions, no? So we've got one up here. Do you have a question? No? Yeah, one here and then one back there.
Thank you. So, my name is Bettina Prato, and I'm from the International Fund for Agricultural Development. So I'm really interested in the evolution of the model from microfinance to, I guess, a fintech platform. What I'm interested in understanding is, so in the model you have 4 stages, and I guess that's about how you engage with clients. But are those also 4 stages in the development of your business model? And so if that is the case, would you say that maybe the lending part is the core element of your business model? Were you able to raise capital around that? Was that sustainable? And then you added the other offerings as, complementing, adding sort of, meeting additional needs? Or were all the 4 elements necessary for you to be able to also have a viable proposition to your investors and to have a financially sustainable model? Does that make sense?
Yeah. So first, we started with the lending. Yes, our core model is the lending side. And the lendings will be profitable next year. Once we reach, we already profitable every year, but we are continue expanding. So we plan to reach 1 million customers and be profitable next year. And we have 4 parts of the elements of Amartha, how we want to evolve. Next is the building the platforms for the group buying model. So how we can decrease this expense, and this part is already piloting. So currently running in several regional, and we plan to full roll out by end of this year. And the next products is the savings is also will launch in this Q4, and the micro investment, micro insurance will be launched next year. That's the plans for Amartha. And when I'm here, plan to talk about our future plan and to raise more funds. That's the use of the funds in the future.
Excellent. All right, last question.
Great, thanks. Hi, Amelie Bodo from the Global Innovation Fund. Sorry, there's an echo. My question's around, there's a growing body of evidence that suggests that adding management training to loans and other microfinance tools is a powerful way to really boost productivity of micro-entrepreneurs. Women in particular, management training that is conscious of, for example, constraints of gender. I just wondered, in your growth, or if you've thought about adding some kind of training component, either as part of a digital platform or in some other way, in addition to the loans and other products.
Yes. So at this part, I only share more about our business growth, our impact plans, and our impact so far in Amartha. But we do have a social project, philanthropy project, where we partners with donors to deliver any types of trainings programs. Like we partnership with Prudential Insurance to provide financial literacy training. We partner up with some university in Indonesia to doctor can provide free health check service for these segments. And also some depends on the partners. We have partnered up with CSR programs, and we give entrepreneurial trainings for duck farmers, specific for duck farmers. So, but the way we manage this social projects or training project is it's the other arms of the Amartha to complement our business plan, our business growth.
Great. So thank you very much, Andi. Let's give him a big hand.
Thank you, everyone.
I'll turn it over to Sarah to introduce the next pitch.
Good morning. Next, we are going to hear Gowri from India, who came to present us CreditMantri. So when we think about fintech, usually we think lendtech or digital payments, but the the emergence of digital data is also allowing for new methods of credit scoring, and this is one of the services that CreditMantri offers. They operate out of India. They have already offered 8 million free credit scores online or provided through the app in a country where there's a very vast portion of the population which is still credit starved, and the latest numbers are around short of 600 million. So this is a very large problem that CreditMantri is trying to address. Beyond the credit scoring, they also offer services to facilitate credit resolutions for those that have been in problem, and Gowri will tell us how our company does that. And last, which I find particularly innovative, is through the data gathered on people they've profiled, and through the number of cycles the borrowers have been through, or those that have been rejected, they also co-create new lending products with financial institutions in order to ensure that those that are credit underserved eventually have a matching offer to their profile. So I would want to ask you to welcome Gowri, who's going to tell us a lot more.
Thank you, Sarah, for the introduction. Good morning, everybody. It's not very often that you're likely to see a woman in her 40s present a fintech to you, which is talking about solving for reducing wastage and driving efficiencies through data and technology. So what really got me here to get started in the process? I actually spent a lot of time working in large multinational banks throughout my career. And one of the things we found was that if there were 100 credit applications that a bank receives, less than 20 get the product. Which means that from a lender's point of view, it's wastage in marketing dollars in sourcing these 80 applications which don't go anywhere. And from the consumer's point of view, it's an unmet credit need. And ironically, this 20 who get access to the product end up getting quoted by multiple financial institutions with a lot of innovation going into product enhancements and product delivery. And the 80 pretty much gets left behind. And that's really the segment that we call as the credit invisibles. So CreditMantri focus is to solve for this segment, which is really consumers who are credit invisible, who typically financial institutions don't have a method to deal with. And if I were to typify this is a consumer who struggles to get credit and get access to credit. So this credit invisible consumer, when we kind of said, okay, so that's a problem, that's something we should be solving for, we then said, what is making these consumers not get access to credit? And there were three big reasons that we kind of pretty much landed on. One was, a lot of them had a poor past, where basically they had a loan, which was a bad loan against their name, which they had not repaid in full, which was coming in the way of the lender wanting to work with this consumer. The second reason that they didn't get access to the product was because they were not present on the bureau. So the lenders didn't have a meaningful way of assessing who this person was and how to kind of get their arms around understanding this consumer. And the third was, if they were credit healthy but their incomes were very low, the economics of sourcing a small ticket loan didn't really work for most lenders. So pretty much between these three categories, most consumers ended up getting rejected for the loan. So if we were to so CreditMantri said, I need to figure a way to solve for this problem. But when you choose to solve this problem, the next question that came about is, looks like the problem is meaningful to solve, but is the size worthwhile for us to create an impact if you really want to change how credit is being delivered in India? And when we looked at the numbers, it kind of shone through in terms of the size of the problem. 1.3 billion Indians. Out of the 1.3 billion, we have about 420 million who are present on the bureau, which means they have borrowed before. There's another 300 million which is present outside of the bureau, which means that they've never borrowed before, they're probably young, new to the workforce and getting in. Of the 420 that have borrowed before, 140 million are credit challenged, which means they have something wrong that they have done in the past, which is coming in the way of borrowing. And of the 280 million that are credit healthy, close to 50% of them have incomes lower than 25,000 rupees per month, which meant that very few financial institutions are willing to lend to these consumers. So add the 300 plus the 140 plus another 140 is how you get the population of 580 million credit invisibles in the country. So what exactly do we do? So consumers come to the CreditMantri platform. Either it could be a desktop or a mobile responsive browser or through an app. We credit profile the consumer using a combination of data sources. We've broadly classified, we work with multiple data sources, but we have broadly classified it as institutional data sources like bank and credit bureaus, which is trustworthy. Statutory data sources, which is government-led, and a lot of work has gone into India in terms of digitizing. So a lot of GST data, Aadhaar, PAN, company-related information. And then you have user-declared data, which could be mobile, SMS, app data, social media data. From all these data sources, data gets processed, put in what we call as a proprietary framework, but this is honestly, this is how most lenders look at a consumer. So which is really look at ability to repay, stability, contactability, ID, and intent, what we call as the ASCII pillars of credit. And having created a credit profile, every consumer on the platform is stamped as a red, amber, or a green customer. Red for credit challenged, amber for new to credit, and green for credit healthy. This, of course, gets split as dark green, which is higher income, and light green, which is lower incomes. Having credit profiled this consumer, the products that are offered to the consumer is a function of the customer's credit profile. So if I'm credit challenged, the focus is from a right product, right service fit, is not to offer the customer an unsecured loan. It's bad for the consumer. The focus is to offer really the customer an ability to repay and resolve his existing loan. If somebody is new to credit, the idea is not to get the customer on track to give him a loan at 32%. The focus is really to say, can I work with a plan where I'm able to work through with a lender to use alternate data to help this consumer leverage his credit profile to get loans at better interest rates. And likewise for the low-income green consumer. So which means that for each of these services, like we work with the consumer on one side, we work with the lender on the other side. So what is the offering? For the red consumer, we help the customer to resolve the loan that he is defaulted on, repay, restructure, access credit while still red, and eventually get choice. And it's all about giving this underserved customer better choice. For the amber and the low-income green customers, leverage alternate data to co-create products with lending institutions so that these consumers are able to get access to products that are not available anywhere else but on the CreditMantri platform. So these are exclusives that we run on the platform. So while that is the consumer offering, what is the value that we add to the lender's side? So when a customer who's delinquent, a credit challenge customer repays his loan, we're actually recovering for the customer. We actually help in recovery of delinquent accounts, which means any recovery is a straight bottom line impact. We leverage alternate data to expand into new segments for the low-income greens and the new to credits, and for the green customer to cross-sell pre-approved programs. So we work with 55 plus lenders across the entire continuum. So whether it's and we work with these lenders to offer standard products, which they have, or co-create the specialized products using the alternate data. And like you can see, there are credit cards, secure credit card, debt consolidation loans, personal loans that we have co-created using the alternate data with each of these institutions. We now work with close to 25 institutions to offer the recovery services. And our profiling engine is used by some of these large lenders in order to make their underwriting decisions. So what is the revenue model? Our revenue model is a combination of consumer pay and lender pay. The free credit health check, obviously, like I said, free, is the hook that draws the customer in, and it's offered free of cost. Consumers come to our platform and we create a credit profile. As part of creating the credit profile, we explain to the customer where they stand. And education, and I heard the earlier question, is built into the module. So it's important for the customer to understand the state of their credit health, where they stand and where they're going. And based on that, we are then offer the customer the ability to subscribe to services. This could be a credit improvement service, a build your score plan, or an EMI saver plan. And that's what we call as the customer-facing revenues. We also get lender-facing revenues, where when the customer makes a repayment, we get a percentage of the amount that's repaid as a commission. For customers that we source for the lenders, we get a percentage. And this model varies depending on whether it's an alternate product that's co-created or it is something that we are listing as a standard product. The 1/3 of our revenue actually comes from customer pay, and this we're really proud of. Simply shows that this is small ticket size, there is a willingness to pay, and when consumers pay, they seek service. And they force us to behave and deliver the service in the manner that it has to be delivered. And 2/3 of our revenue comes from lender pay. So what are the key matrices? So we have 7.8 million users who are credit profiled. So a large user base, of which 78% belong to the underserved segment, out of which 880,000 users have moved on to become paying customers, so which means we have monetized them, which compared to most players who work on this space is a conversion percentage. Ours is trending close to 12 and 13% levels, which is significantly better than competition or any other player in the space. We've disbursed close to USD 100 million in terms of loans through the platform, and clearly are a market leader and an innovator in this space. Work with 55 plus lenders, where there's a depth in a lot of the relationships across collections, underwriting, and new acquisitions. And we closed last year in terms of revenues at 4 million. So there is a sustainable business model in terms of repeat rates, unit economics, and break even. So some of this, I think our lender base is quite strong. We understand the consumer, and the offering is actually differentiated based on the customer's credit profile. So the journey and the products that we offer varies depending on each customer's credit profile and what is right for the consumer. So it's not something that we have a product and we just want to sell it to everybody. So because we understand that a red customer, actually counterintuitive, has the highest salary compared to all the segments, and that's because the average age is the highest. So they've had enough time to kind of mess with their credit profile, which typically when we think red consumer, we think bad customer. But actually a lot of them, it's just been a point of time where they've had a challenge and they are wanting to and willing to reconcile. Our approval rates on the platform, so 100 million disbursed. What we see is that the approval rates on our platform versus competition is significantly better, particularly for the challenged underserved segments, which is the NTC segment and the low-income greens, where when the market approval rates are at 1%, we're at 11%, and when market is at 3% for the low-income greens, we're at 10%. And overall, we compare for the dark greens at about 6%. That's really the market average. In terms of delinquencies, our delinquencies are, are better compared to the market. And this is really on the tailor-made product set that we drive with the consumers. And on the recoveries, which is straight bottom line impact, life to date recovered close to $10 million US dollars. So users are coming back for more, repeat rates are significantly better, and there is an inherent value to the user base because monetization is coming from 70% of the users the revenue that we earn is coming from users profiled in the previous months. So where are we? Market leader in the credit challenge segment, only digital player offering a meaningful approval rate-led model for the low-income greens and the NTC segment, even compared to the fintechs who are now lending in India, and almost all of them are listed on the platform. And the reason we find the fintechs struggling, the lending fintechs, is simply because they find that the risk in this segment is higher, and their balance sheets can't take on that risk. And consistent growth in revenue. The really good part is that we are close to break even, expecting to break even by December of this year. So many innovation, many market firsts. Strong team, so we're very proud of the team with a lot of rich, diverse international experience, moved back to India, that's the co-founders. A lot of good feedback from customers. Our customers have good things to say and bad things to say, but the good things are what we make our day, the bad things are what gives us more work to fix. And where we are, so looking to break even by December of this year, last year closed at 4 million, heading towards doing 5.5 million this year. And looking to probably raise another small round of funding of 3 million, because we feel that both from a growth perspective and from a positioning perspective, it is an essential market, and we seem to have hit a sweet spot in terms of making the model work in a capital light fashion. So that's really it. Thank you. Thank you for questions.
Thank you very much, Gowri. Maybe a first question that comes to mind, you can stay here because you're going to have to answer. First question that comes to mind is, in a world that is getting more and more digital and with the availability of data becoming more open, whether it's forced by regulation, as we've seen in the open banking system, or while it just happens because people are using their mobile phone more and more and have a digital footprint, how do you expect to remain relevant when everybody's data is available to everyone else?
So I think the availability of data makes our life simpler. It took us a lot of time to convince the regulator and the credit bureaus to get us access to the data, which we felt we were legitimate in getting, because we needed to make sure that the data that we procured was secured and that we needed to make sure that it was not getting misused. But that is just step one. Actual work that goes into credit profiling a consumer is not necessarily getting to access to data. While it's important, a lot of work goes in terms of processing the data into a framework that allows us to wear a lens, which helps us to assess ability, stability, contactability, intent, and ID, which is overall the lendability of the consumer. So the processing of the data is just as important. So I think having access to information makes us focus on the right problem, which is not in sourcing the data because it is available, but in working through the processing of the data and to actually work with how the consumer is behaving, because the infrastructure of the data in itself becomes available. What then becomes necessary is when the data is widely available, given that we operate in financial services, the entire thought process of compliance around privacy. So ours is a completely consent-based platform. I need to have the customer present on the platform, registered with a mobile OTP and a KYC done in order for us to create a credit profile. And this has to be done real time because otherwise the math does not add. And having credit profile the consumer on a consent basis, we see ourselves as custodian of the customer's data, which means unless the customer gives me consent, I can't really pass on his application to a lender without actually Gowri allowing for her data to get passed on to an HDFC bank because Gowri wants a loan from HDFC bank. So we see ourselves as a custodian of the customer's data and not necessarily as the owners of the data. And that makes a difference in how we work with it.
Okay, understood, thank you. I'm going to open the questions to the audience. Unless Craig, you have a burning question? Yeah.
I'm totally fascinated by this rehabilitation process and people who've been sort of kicked out of the credit market back again. So if you could clean up their credit bureau, credit records, that'd be really interesting.
So what we do is consumers who come on our platform, when we pull out the bureau, we're able to see that, let's say I have two accounts, one from a Citibank, my credit card where I've had a settlement, and one where I have an HDFC bank where I have a written off account. And Gowri then, step one is opts for this service of wanting to resolve the issue with the lender. So step one, we pass on the customer's details to the lender and get the information from the lender on what Gowri has to repay as an amount in order to make a clean closure on the bureau. Along with that, our backend model automatically breaks this down because we've tied up with the lender for a policy to say that, how do I break this amount? Let's say Gowri earns 25,000 rupees a month, but the amount that she has to repay is 60,000 rupees. I don't have that kind of surplus to repay it in a lump sum. So we have pre-worked policies with the Citibank or with an HDFC bank to say, when I'm able to recover for you, I want to be able to break it into a payment plan that works for the consumer. Most lenders are very comfortable offering this because for them, it's a straightaway bottom line positive because they've anyway written this off in their books. So working through and driving this payment plan, so once we present the amount to the consumer, that Gowri has to repay 60,000, consumer opts for, do I want to pay in full or do I want to break it into a 4-month, 6-month or a 12-month plan? When the consumer opts for that plan, we then make the customer make the payment for the first or the total amount, whatever he opts for right away. And he makes it online, so we don't collect the money, it gets straight away paid to the lender. And subsequently, depending on the plan the customer has subscribed for, we work through with the customer to make sure that he has reminders in place to track the repayments. For amounts which are very large, we have tied up with non-banking financial companies in India where they're willing to lend to the customer in order to clean up and consolidate their loans. Where, however, the contribution in terms of the customer's contribution has to be 25% of the loan has to come in from the customer, and the loan itself gets credited directly into the lender to whom the repayment is due. So that's really how the process works on the credit challenge side. Along the way, after resolution, what we also end up doing is offer the customer score enhancers, like a secure credit card if they don't have an actively running credit product, so that their bureau score starts building once the resolution is done.
Any other questions from the audience?
Thank you for your presentation. I'm curious to know more about what you call the credit challenged. Who is a credit challenged person exactly? And how do you target, no, you do target them, but how do you target them? Because I'm thinking of people who don't have access to the internet or to, let's say, education. Do you target those? And if so, how do you do it?
Okay. So credit challenged is somebody who has borrowed before and therefore has a default in the past. And the default could be they are delinquent for 30 days and above on the bureau. So that is the definition of a credit challenge customer, which means that the degree of default obviously varies. Somebody who is only 30 days delinquent is very different from somebody who is suit filed and has been delinquent for many, many years, and the lenders are seeking legal reparation to recover whatever they have to. So that's the definition. So we look at the data, we parse the bureau report, we have our own model to kind of identify the credit challenged consumer. How do we source these customers? I think that's a great question, and I think while most delinquent customers know that in the past they have had a problem, the tendency is to forget about it or overlook it. And some of these situations are real. I had a job, I used to work, I was sent abroad for a software project. I went, I set up a new life and spent 6-7 years there. I forgot about the credit card that was given to me. I come back, I apply for a home loan is when I realize, oops, I have a delinquency and my home loan has been rejected. That's when the reality hits many of them. So typically, some credit challenge stumble upon the fact that they are credit challenged or red when they are curious about their credit score and come and do a free credit health check. Some of them get it when they are rejected by a financial institution, saying that I can't give you a loan because they applied for it. And some of them are just understand that in the last few years, this thing called credit score is gaining traction. I know I had a delinquency in the past. Let me see if it's still showing up in the bureau. Any of these are triggers. So we're present online. We work with lending institutions. They give us their delinquent basis. We also work with a lot of fintech lenders with whom we have partnerships where customers they are not able to approve, they send them across to us. So that's really how we source them. But the funny thing is, given how India works, if we get 100 credit profiles, we find that the world usually lands at 22 to 23 of them are credit challenged, about 35 are new to credit, and the remaining 40 are credit healthy. So, you can have one or two sources which behave a bit differently, but the numbers that I gave you are actually in line with the market data. And it's kind of, when you deal with it at scale, it's kind of beautiful to see it come together like that.
I'm told we don't have any further time for questions. However, all the entrepreneurs are going to be available after this session, and they're also offering another pitching session, so I'm sure there'll be a chance for those who have questions to further interact with them. Thank you very much, Gowri. I think we're going to move.
Thanks, Sarah. So moving on, there's a really interesting financial dynamic where expatriates are sending home money to developing countries, and that money ends up not always getting used for productive purpose. So the development community is like, how can we tap into remittances and make it productive in some way? And so our next pitch is from the founder of Kim's Microfinance, Justin Sykes, who has a model for making remittances productive in one of the most challenging markets that you can imagine. Justin?
Wonderful. Thanks very much, Craig. Good morning. So financial inclusion is not just a human right, but in the Horn of Africa, it's critical to achieving peace and stability, addressing the root causes of forced migration, and mitigating climate change. I'm Justin Sykes, and I'm the co-founder of KIMS Microfinance, Somalia's only dedicated commercial microfinance institution. Somalia has emerged and is emerging from 30 years of brutal civil war. It's destroyed institutions and it's spread its population across the world. Stability is coming. There's been the re-establishment of the federal government, the first election in over 25 years, the return of international institutions. The HIPC debt relief program is well underway, and it is looking like Somalia will be forgiven its debts early next year, which will allow the World Bank and other international financing institutions to come back into Somalia and start lending, which is critical, obviously, to the long-term growth of the country. This recovery, however, is fragile. Less than 10% of the Somali population have access to financial inclusion, and that is stunting the ability of the country to grow and transition to stability. KIMS was founded in 2014. It has grown from a startup pilot operation in Hargeisa in Somaliland, in the northwest of the country, to now 13 branches in 10 cities across all Somali territories. It has financed close to 15,000 loans, disbursed around $15 million. It now has around 4,500 active clients and a gross loan portfolio of close to $3.5 million. The business has a very strong job creation angle and has had significant success in creating jobs, for example, through cooperative financing. So key features of KIMS. KIMS provides ethical and religiously appropriate financial services to vulnerable and low-income Somali populations. It's the market leader in providing micro and small enterprise financing in the Somali territories. It has individual lending, SME lending, group liability lending, and then, very importantly, SDG-aligned thematic loans. Displacement is a key issue in Somalia. You have a very large, over 1.5 million displaced population internally within the country, both from conflict and climate change-related displacement, famine and cyclones. You have a very significant returnee population, now upwards of 150,000 Somalis who are returning from being long-term refugees primarily in Kenya and Ethiopia, and other refugee populations from the Yemeni conflict, for example. So displacement is a key area of the loan portfolio. Energy access and fisheries and agricultural cooperatives. Ikram, who featured on the cover slide, is a returnee. She's a refugee for 15 years in Dadaab refugee camp in Kenya, returned through a voluntary program, which is anything but voluntary, but that's another story. And she's been provided with, through a partnership with UNHCR and the American Refugee Committee, entrepreneurship training, financial literacy, business support, and then linked to a startup loan. And she now runs a small store that allows her to afford to send her, to feed her children and to send some of her older children, a couple of her older children to school. KIMS is achieving steady organic growth, and this has largely been driven by donor funding over the early years and retained earnings. The business is now posting month-on-month cash positive, has a positive operational self-sustainability. The loan book had an income in 2019 predicted of about $500,000. The business now is evolving from that early model of donor financing onto concessional capital from primarily foundations and Gulf cooperation country DFIs. And now really the business is at that inflection point where it is poised for growth and is now engaging with larger, more commercially orientated investors, so DFIs and institutional investors. SDG alignment, primary alignment is with goals 1 and 8 around poverty alleviation, through access to finance, and through the almost entire portfolio being micro and small enterprises. There is a strong focus on job creation, SDG 8. Secondary alignment is around gender equality, solar, through a solar home loan program, which is scaling up, and then climate change through climate smart agriculture. So, for example, financing solar water pumps, climate smart cooperatives, sustainable fisheries. In terms of partners, as mentioned, the early trajectory of the business was primarily focused by tier 1 donors, DFID, USAID, some of the multi-donor trust funds, such as Somalia Stability Fund, the African Enterprise Challenge Fund, UN agencies. Then moving into that concessional capital, primarily from the Gulf Cooperation countries, engaging with technical partners more deeply over the last year or so, so IFC, Islamic Development Bank, EY, and the African Local Currency Bond Fund. Very importantly, the relationship with the bond fund is now on track to be our first institutional investor, which will be a decent-sized debt relationship is being agreed and will be concluded by the end of the year. So, what are the USPs of KIMS? So, it was mentioned by Craig, this business was founded by a remittance company for the Somali diaspora. That remittance company is called Car Express. It has offices in over 40 countries around the world, including in the EU, North America. They have over 100,000 clients, and they remit upwards of about $30 to $40 million a year from diaspora sending money back to their extended family in Somalia. Remittance is being used as partial collateral to allow the extended families to borrow from KIMS. The remittance business is in effect cross-selling microfinance, as they have over 300 agents and branches across Somalia. And as Craig mentioned, there's a very significant opportunity that we're exploring right now to look more strategically about how we leverage remittances to create a remittance to save, to invest model. Because ultimately that $30 million coming annually could be, if well structured, a secure and probably the cheapest form of capital that KIMS could basically borrow. Technically it's complex, but it's not insurmountable. Mobile money. So mobile money is ubiquitous. It's the equivalent of M-Pesa in Somalia, and that's being used to manage all loan repayments. And the next stage is a digitization strategy, which would allow for a loan application to be developed and leveraging the Islamic core banking system that the business is currently using. And then, really importantly, is this other aspect about regional expansion. The business started in Somalia. My fellow co-founders are Ethiopian nationality. The business climate in Ethiopia was not conducive to launch 4 or 5 years ago. It is now. So although the business is focused on Somalia and has built a successful business model, the opportunity now exists to take that business model and apply it across borders in Kenya, Djibouti, and Ethiopia. There are 30 million ethnic Somalis across the Horn. That population, in terms of access to religiously appropriate microfinance services, is almost non-existent. So the KIMS model offers significant opportunity to serve those populations in a more mature market where, for example, digital technologies can be leveraged in Ethiopia and Kenya. In terms of awards, as mentioned, KIMS has had a strong focus on the displacement issue and has been awarded the Ethical Finance Award and other displacement-focused awards. In terms of the team, we have a mixture of commercial business acumen, impact investing, Islamic finance, policy experience working for the IMF and the Central Bank of Somalia. So this is Kim's story. In summary, the business is at an inflection point now, is demonstrating that it has a successful Islamic microfinance model that is scalable to a very large underserved market, 30 million Somalis in the Horn region, 80 million Muslims in the broader East Africa region. The business has achieved month-on-month profitability and is at a growth point. We're set to secure our first institutional investor at the end of the year, and Kim's is looking for, over the next 18 to 24 months, is looking for 5 million in debt financing, 2 million in equity. So the debt financing will be used to expand the loan book. The 2 million will be used equity financing to expand the business in Somalia, support market entry into Ethiopia and Kenya, support a digitization strategy, and new product development, including insurance and the remit to save or the remit to save to invest product. In addition, we're likely looking at about 1.25 million in donor funding, which would really allow for risk capital to test out new products. And that is Kim's Microfinance, and happy to take questions.
Thanks, Justin. So a quick question from my side is portfolio quality. So one of the most difficult environments to operate in. What is your portfolio quality, and how are you managing credit risk?
So portfolio quality is around 5%, par 30, so it's been kept within tolerable margins. We were talking earlier, one of the challenges is a donor-driven model whereby donors are putting conditionality around various client cohorts to be served. We learned this the challenging way when it came to the refugee portfolio, where the refugees were basically assigned to be financed and there was no ability to determine credit risk with the beneficiaries. That, however, hasn't put the organization off the displaced segment, and it's a learning that has now gone on to actually prove out that providing finance to displaced populations is commercially viable and has deep social impact. So, yeah, moving away from conditionality. And then I think the other factor to manage portfolio risk is the unique relationship with the parent company, the remitter. So if the remitter is providing families in Somalia, extended families remittance on a monthly basis, that is being used as partial collateral to then lend to the extended family. And in the event of default, the next month's remittance can be used to basically recover financing.
All right, we have time for one question, I've been told. Who wants to be the lucky winner? Okay. Oh, there we go, lucky winner.
So my question is about your capital raising strategy. I mean, you are specializing, at least in part of your product offerings, on Islamic finance. Is that also the way you're pursuing your own capitalization? And if that is the case, what is your sense of, the availability of, what is the nature of this market from an impact investment standpoint? Sort of who are you going to for that?
Fascinating question. This is really frontier work because ultimately the business needs debt financing, but that debt financing has to be Sharia compliant. So we're doing at the moment, which probably will be one of the first transactions globally, to basically structure a bond, a corporate bond issuance, which is technically an Islamic bond, that would allow an investor to achieve a fixed return whilst ensuring that the investment structure is Sharia compliant. This has never been done in microfinance before. It's done in corporate financing. And we have design funding to do this. We have Sharia finance experts. It's being done through a Mauritius structure. So it's very complex. But I think if we get this right, it opens up the door for much greater pool of financing. And we've been, DFIs and some of the impact investors are looking at this because it is so innovative. And we hope it creates a platform to do more.
Great. All right. Thank you very much, Justin. Thank you. And Sarah can introduce the last pitch.
All right, we're just going to do this sound.
presentation is being set. Is this working? Yeah. We're moving continent now with Alex, the CFO of Tienda Pago, operating out of Mexico and Peru. They are offering very short-term working capital finance to small mom-and-pop shops in order for these shops to increase their inventory, to buy more from the large suppliers. The large suppliers that they have partnered with are essentially FMCGs, breweries, Coca-Cola or dairy companies who do obviously see an interest in partnering with Tienda Pago, considering they can increase their business and reduce their receivables. The size of the business today is a monthly disbursement of about $6 million, and they have 35 of those shops enrolled in their program. Alex, up to you.
Thank you so much, Sarah, for the introduction. Okay, whenever you say. No, I won't touch. So, no, but that's the third slide. Huh? Yeah. No, but.
Présentateur, il faut qu'on sorte du mode présentateur. Il est où le mode présentateur? C'est ça. Enlève le mode présentateur. C'est nous.
Sorry, everyone.
Yes, I'm gonna start talking a little bit what we do. There are more. Oh, there you go, right in time. In Latin America, we have more than 3 million mom and pops in the region. I don't know if you know, but 10% of those stores usually die on a yearly basis, mostly because of lack or a chronic lack of capital. My name is Alexander Golding. I'm from the exciting team of Tienda Pago, that we came here in order to solve this issue and prevent these stores from dying on a yearly basis. Okay? We know, I mean, that in order to have a full financial inclusion, we'll still have many challenges in front of us. In Latin America, even though the smartphone penetration is between 80 to 90%, usually the base of the pyramid is not fully digitalized, and they're not used to use financial products. We at Tienda Pago believe that we can make a change basically by designing products that are tailored to their necessities. Secondly, using technology to make these products easy to use, easy to understand. And thirdly, using data in order to make these products sustainable and make sure that we do not hurt the financial well-being of these stores. So I'm gonna show you a video. This is Anna. She's an associate partner of us in Mexico City.
She owns a corner shop with her family in Mexico. There are over 1 million such shops throughout Mexico, and they provide all the necessary products and services within their communities. These bodegas are everywhere in Latin America and emerging markets worldwide. Ana and her family live in the back of the store, often working 17 hours a day. Their personal finances and those of the store are one and the same. She suffers from a chronic lack of capital and continually runs out of products. Ana and her family's finances are very vulnerable. She often must choose between buying inventory and family expenses like school supplies for her children. The problem grows. She has no credit history, bank account, nor credit for the store. So she is at the mercy of local unregulated lenders at predatory rates and threats of violence. Ana's problem is epidemic in all emerging markets, yet these bodegas are the lifeblood of communities and the key for commercial development.
So you met Ana. What are the two big things that we're addressing? The first one, Ana having a limited capital definitely impairs her ability to grow her business. On the other hand, that capital limitation also limits her possibility to take advantage of promotions and new categories that the big FMCG launches and focus to this channel. And very importantly, she's because of lack of capital, she is vulnerable to the daily shocks that she can have in her daily life. On the other hand of the problem, we have the big brands. The big brands are also hurt by the lack of capital of this channel, but they are also constrained for having to manage cash throughout their business cycle. So with Tienda Pago, and handling cash is very costly to them. In the end, what happens is that delivery trucks from Coca-Cola, from the dairy company of this world, show up to the store, and they have to stop several times until the store has enough cash to pay them for the inventory. That's one of the things, pain points that the big brands are having. Managing cash, as you all know, is risky, and there is definitely additional inefficiencies by the end of the day when the route goes back to the distribution center and they have to do the route reconciliation. It takes a lot of time to count the cash again. So what we develop is a solution to tackle both things, or both parts of the equation. On one part, we are offering 1 week working capital loan to these mom and pops, to these small stores that are cash starved, and on the other hand, we're enabling a cashless solution to the big brands. And in other words, the delivery truck can collect the inventory that they're selling through their cell phone. And this is the first time that the big FMCGs have been able to do so in the region, even though they tried this for many years before. So our business model is very simple. We have a very collaborative model, very integrated model with the big brands. The way that it works is that we establish alliances with the dairy company, with the salty snacks company, and we share data in order to make a credit assessment and come up with a pre-approved list of stores that can have our line of credit. Then we engage with the brand's sales personnel. They are the ones who are pitching for Tienda Pago. They are the ones who have the relationship with the store, the trust of the store, and that's why this is a key channel, sales channels for us. If the Annas of this world want to become part of Tienda Pago, we make it very simple. They can be onboarded through several channels, either through WhatsApp, an app, or either a call center, or we can pay them a visit if it's necessary. And while she's onboarded, she can start using her line of credit to buy supplies for her store. At the end of the day, once the cycle ends, we transfer the money collected by the truck through Tienda Pago electronically to the brands. So in that sense, we enable the cash collection for these FMCGs. And 1 week after, the store has to go to the banking system or to a corresponding agent to pay Tienda Pago the principals and the fees associated with our product. So who are we financing? I mean, the Annas of this world, how do they look like? They sell between $500 and $1,000 a week. They are predominantly served by women. Almost 2/3 of these stores are served by women, usually between 30 to 85 square meters in size, very vulnerable, business savvy, but very unsophisticated. And this problem is massive in the region. As I already mentioned, there are 3 million mom and pop stores in the region. More than $100 billion of sales go through this channel in Latin America. And this channel is very, very important to the big consumer brands, representing more than 70% of the sale that they do in this channel. So what is the impact? The impact that we've been having is the people that use the Annas of this world, that use Tienda Pago, grow or sell 20% more than the stores that do not use it. These figures come from the FMCGs themselves. It's not that we calculated them. And the other impact is that we make them more resilient to any shocks that they can face. For example, the death of a relative or actually being robbed at the store. They have the confidence of having a line of credit to fulfill and make their business going regardless of the shock. And on the other hand, the brands benefit from having a stronger traditional channel. As I mentioned, very important for them. They rather have a wealthy amount of stores rather than dealing with the Walmarts and the 7-Eleven of this world. and definitely they are able to capture efficiencies, operational efficiencies, and reduce risk of handling cash. So what's been our story so far? We have more than 35,000 stores on their platform. More than 28,000 stores have used Tienda Pago. We've impacted more than 100,000 people with our products. We expect to be closing the year lending $90 million, triple that by 2020, and double that again by 2021, reaching and going from a revenue this year about $3 million, so almost to 16 in 2 years. So, but this is the present, and the future is more exciting. Okay, we do not expect to be financing only physical inventory. We're also aiming to finance digital products and services such as airtime, pop-up, and utilities, and allowing them through our app so they can sell additional digital services, as for example, Netflix subscription, iTunes, or Play Store, enabling them through our app as well to receive digital touchless payments. And the idea of all of this is make these stores stronger and become the center of their communities. So rather than selling myself the impact that we're having, well, you have the subtitles in there.
La verdad a veces que las ventas luego no ayudan y bueno, sirve que tienes un poquito de todo y manejas, pues bueno, con las aplicaciones y todo, yo pienso que sí, queda muy bien.
Bueno, quien maneja el celular es mi hijo. Tengo un jovencito con discapacidad y él es el que me hace todo eso, ¿eh? Yo pues nomás le digo, mira, son tanto, o él recibe el pedido de hoy, martes, recibe el pedido él. Entonces él me pone todo en orden.
Pues la verdad yo agradezco infinitamente porque gracias a ello mi negocio ha crecido. Entonces les agradezco a cada uno de los que trabajan, desde la primera persona que llegó aquí, y yo sé que atrás de ellas hay más personas que yo no conozco, pero son parte de, y les agradezco infinitamente porque sí ha crecido mi negocio y de gran manera, de verdad.
Muchas gracias, Tienda Pago.
So we want to make this dream happen. We want to replicate these success stories of the Marias, of the Josefinas of this world. That's why we want to take our model to more than 500,000 stores in the region, and that's why we're aiming to be talking to you and aiming to raise $20 million in additional debt for the next year, and hopefully close a Series B round by mid next year between $20 and $30 million. Thank you so much.
I'm going to ask questions myself to leave space for the audience. Has anyone questions? Yes.
Hello. This is a very European question, but over the next sort of 10 to 20 years, do you see that market consolidating? You know, you end up with 7-Elevens, co-ops, supermarkets.
No, actually that was something that was expected to happen. Everybody thought that was going to happen back in the 2000s, and it didn't. And the reason behind that is because you have big brands, and in the case of Mexico, you have not only the soft drinks, the brewery, the dairy, you have salty snacks, you have a lot of companies developing a lot of money to preserve this channel, to make this channel thrive, and that's, I think it's one of the main forces on why the amount of stores has remained flat. It actually grows a little bit, but it's been around 1.2 million in Mexico, for example, and 3 million around the region.
And just from a health perspective, obviously brands like Coca-Cola and sugar and carbs, I'm just curious, are these places selling fresh product as well, or is it all...
They sell perishables, they sell cheese, they sell dairy, they sell bread. They sell a wider range of categories, but again, yes, they also happen to sell soft drinks such as Coca-Cola. Mm-hmm. So I think that's more about consumer habits rather than another question. Yes.
Patrizia Richter, I work for the International Labour Organization Social Finance. I want to continue where you left off. I think this is really great because this is where the money is needed. Mm-hmm. What we have also seen in this space of small scale loans is that there's a focus on impact and not so much looking at the risk side of social and environmental risks that come along with those businesses. So I wonder, especially with the stores, and you alluded a little bit to it, family-run, household accounting, business accounting is the same. They live there, the kids are around. So is there any mechanism that you have put in place to identify at first what social environmental habit risks are around there that could actually be reinforced by growing the business, or is there any drive towards mitigating those risks that you might identify at the baseline?
I'm gonna try my best to answer your question. I think as you mentioned in the beginning of your question, our main goal is to make this store stronger so that it can grow, so that the women serving this store can send their children to have an education and be more resilient to a shock and have a better quality of life in the end. Okay, so regarding your question of, for example, environmental, we work with the consumer goods brands. I know they have an environmental footprint, and when we have to work together in order to reduce that footprint. But I think again, our main goal is to making this store stronger, more means for them to develop. I don't know if I answered your question, but I did my best.
Thank you. How is the loan return? And they have to go physically to a branch and then deposit into your account?
Yes, that's the way that it works. Yes.
Okay. And so, do you have any idea to improve this regarding digital means of payments, or
that's a very good question. And we also offer them the possibility to pay us through an electronic transfer through the banking system. But the reality is that less than 3% or 5% of our stores actually do so. So this is a massively unbankerized population. We see that maybe changing when the moment of digital wallets and a greater bankarization starting to happen in our regions, then we definitely want to bring some more efficiencies in how they pay to us.
Could we say that you are offering services that are similar to what Square is offering, but to a much lower...
In a different region, much lower ticket size, yes.
But kind of concept.
Yes, Square in the beginning, okay, they offer payments, but at the same time, right now, they are offering loans to restaurants and so on. But yes, we're financing stores, their inventory, on a much different scale, in a different region, yes.
Any other question?
Yeah, okay, over there.
It's Farhan from the World Bank. Muchas gracias, muy interesante la presentación. I think in the video it mentioned that some of these tiendas used to use informal lenders, and there was at some point even like subject to violence. So of course, like your service is disrupting that informal dynamic. So maybe if you could like have a couple of words on how, if you have faced like this kind of like pressure from like this informality, if some tiendas where maybe using your service had to go back to like that informal pressure. So that would be an interesting aspect of your work.
Yes, I think we give them the opportunity to have a loan and a financing that it's not predatory. That's one thing. The other thing, I think their product, since it's tailored to their necessities, they definitely see it as a, because in the end we're financing their inventory, right? So I think it's a natural fit of our product to what they actually need. And going back to your question about, I mean, the pressure, I mean, we haven't heard of anyone saying, you have to go back to the informal lenders. I mean, so far, I think we have a very good product. People see the value, and they start engaging with our product and financing their inventory and see that it's easy to use, and we have a good engagement.
One more question? It's coffee. Okay, sorry.
Thank you so much.
Thank you. again, I want to reiterate that all the entrepreneurs are available should you need more detail, want more detail, would want to engage with them. I think they've each expressed what they're looking for coming to Geneva today. So feel free to engage with them. I would like to thank Walid and the conference organizers for allowing this panel and the FinTech finalists to present their business models. Thank you.
Just before leaving, I would like to thank one more time all the entrepreneurs and our moderator, Greg and Sarah, for being here. So now it's time for a well-deserved coffee break. And the 7:30 we start again the pitching session. If you want to see climate, please from the agenda. So climate is here, health is here, and Accelerator 2030 is in Brazil. Thank you very much and enjoy your break.